All right, we're doing a 2-for-1 on this camera here. Just making sure just want to make sure we've got a clear, concise message for everyone. All right, we're 2 minutes past, and in general, we want this to be brief so that we're available and ready for the day in general as markets start to open. I'm going to turn it over to Matt and let him do a lot of the heavy lifting for today. And obviously, Aaron's on the call with us as well. The reason for this call is, hey, we've had some market sell-off to start the year. They've accelerated a bit. Yesterday was a wacky day in general, down big, finished positive slightly in U.S. equity markets. So just want to touch on all that. I know we had the call last week where we did speak about a few of these things, but just as kind of a follow-up, as things have changed a little bit in markets, Matt's going to talk a little bit about where we are, what we're doing on our end, and give some perspective on how these things have occurred in the past. So without further ado, I will turn it over to my esteemed colleague right to my left here.
So clearly, due to technical difficulty, we are not social distancing this morning. Pat and I are right on top of each other here, but all good. As Pat said, we wanted to do a quick follow-up call from our call last week because markets move quickly, and we have some developments in the markets since we gathered last week for one of these. So as of yesterday morning, officially and technically, the U.S. stock market is in correction territory. Just to define that, a correction in the financial world is generally defined as at least a 10% sell-off from a recent high. And the S&P 500, which at least in the U.S. is sort of the bellwether index, crossed that threshold yesterday morning. But in general, a lot of other indices have already been there for a while. For example, so the S&P at its bottom yesterday had declined about 12.5%. NASDAQ was down a fair amount more than that, over 15%. Foreign markets down about 12%. And then the real loser thus far in this move, small caps, the Russell 2000, down over 20%, with parts of what would be considered more the kind of growth and innovation, the disruptive tech, that area of the market that had been really flying higher at the beginning of COVID. Some of those areas, depending on how you define an index or a fund in that area, are down over 50%. So there's been a lot of damage done in the market, really in a short amount of time. And before we get into some historic context on that, and then most importantly, what we're doing about it, just wanted to give potential reasons. And we won't spend a ton of time on this because to a certain degree, there's always a reason. You generally don't fully know until after the fact. And the market is not a human where you can ask a survey, hey, what's the reason you're selling off today? You can only sort of speculate on that to a degree. But a couple of the things that we think played into this one. On the valuation side, stocks, as Pat had mentioned, had a great run up for a couple of years, right into sort of late last year at the index level around Thanksgiving. And valuations are a little stretched based on historic context. Maybe not compared to interest rates, but that segues us to the next potential cause, is that interest rates started going higher. Both the Fed talking about raising rates and market rates, 10-year and other interest rates going higher. And a lot of this rally over the last decade has been pegged on this idea of what some call the TINA rally, which stands for there is no alternative. So the higher rates get, there is a fear of maybe now there is an alternative. Maybe I can make some decent money on bonds or cash. I think we have a long way to go before that's real, given that a 10-year bond still yields below 2%, but certainly it's higher than it was, a few weeks back. And then the last parts of the potential causes, we have COVID still rearing its head, causing maybe some economic disruption, but certainly a lot of societal and political angst, not to mention the public health side of that, of course. And then finally, we have geopolitical instability with this idea that Russian troops, I last heard maybe about 100,000 are on the border of the Ukraine. Unclear what NATO, the US, Europe are going to do about that. Unclear what Russia's even going to do, but certainly causes some unrest when we're already in sort of tense global times. But put all of that together, just for some historic context, even though the causes are always different, the sort of behavior here is pretty normal. We get on average one correction, which defined again as a 10% sell-off, but not quite a 20% sell-off, that range. We usually get one of those every, give or take, 15 to 18 months. Over the last few years, we've essentially gotten two in the last 38 months. One was the nasty COVID sell-off, when COVID first started in early 2020, and this one. So, you're right on sort of on average right here. Historically, some of them go on further into a bear market, generally a fraction, less than 50%, but it does happen. Not saying it couldn't happen this time. And usually, given that markets over time grind higher as companies keep putting up positive earnings over time and figure out their environment. And this is at an index level. Certain companies, go lower and stay there. But at an index level, they tend to go higher. Usually, sell-offs like this are a long-term buying opportunity. So let's get to that. Let's get to what we think about that and whether this is an opportunity to sell, an opportunity to buy, or an opportunity to do nothing. And as any of you that have worked with us for a while know, our sort of investment philosophy is that if you invest long enough, this is sort of the price of admission. There are going to be really lousy markets. And people who sell into that out of either fear, panic, or material need, they need money at that moment, tend to struggle to reach their financial goals. People who hold on tend to do fine. And people who buy more, that's usually when you make your biggest returns. And so a lot of what we design is the ability through our advice and conversations and planning so that during these moments, at worst, you can hold and ride it out. And at best, we'll do some buying. There are always exceptions, but that is our goal. So given that, what our feeling is right now is this is a modest buying opportunity. This is not back up the truck buying opportunity of the century. We'll never see these levels again. I don't know that. These levels could be worse in 2 weeks. But what we do think is that markets are, let's go with what we know. Markets are cheaper now than they were 4 weeks ago. They're cheaper now than they were at the beginning of the year. And frankly, they're cheaper now than they were last week, other than that little rally we had yesterday afternoon. So we want to, in general, add to stock. So what does that mean? Let's hypothetically say there is a portfolio where their neutral allocation is 60% equities. We have plenty all over the map. Let's just use that for hypothetical example. Chances are right now they're at 56 or 57 because of the sell-off. We would take them back to 60. We're not advocating taking that person now to 65 or 70 or making a bigger move. That would come potentially if this keeps going, if the sell-off deepens. And where are we adding? What areas do we like and do we want to add to in portfolios right now? If I were to crudely sort of chop up the whole stock market into three categories, you have your large US stocks, let's say things like the S&P, the Dow, the NASDAQ, things that we hear about in the news more. You have, let's say, foreign stocks, anything that happens outside of the US, both developed Europe and Japan and the more developing markets. And then you also have small and mid stocks, small and mid-sized public companies in the US. If I would just categorize those three categories as defining the market, and other people can slice and dice them however they want, our plan is, while we will be adding when rebalancing a little bit across the board, we want to start favoring those latter two categories a little bit that have lagged over recent years, frankly, recent decades in a lot of cases. And that is, we want a little more international than we had before. Their markets are cheaper than ours. I think it was Goldman Sachs put out a piece last week or the week before saying that they think their economic growth by next year, 2023, will be the same or better than ours. And if that were, and frankly, their central banks are still in accommodative mode where ours is at least trying to be less accommodative. So put all that together, we like international a little bit here. And there's been so much damage done in small and mid cap stocks where we have some exposure in our portfolios, but not a lot. And we would like to add to that in that it's our belief that innovation and what sets, in a lot of cases, the US economy apart is our innovation is not going away. Doesn't mean that the stocks didn't get too frothy last year in some cases, and doesn't mean that the sell-off wasn't justified in some ways, but we do think there's some opportunity there going forward. So again, in summary, what I'd add here is we've been here before, we'll be here again. Not saying it's over. Based on the technical behavior yesterday, plus a little bit of the sell-off this morning, looks like the market is trying to find a bottom, but that's the limit to my technical knowledge and not an area where we pretend to be experts. We're more long-term investors, but we think this is a decent opportunity to rebalance, add a little to stocks and add a little to some out-of-favor areas. So with that, I will pause. I don't know if there's anything else, Aaron or Pat, that I didn't cover, but fire away.
No, I think that was thorough. I think Matt's point is well taken. We've been fielding a lot of questions with regard to what's been going on. And the point is, we've been here before. We're going to be here again at some point, and we're going to use this as an opportunity to make smart tactical decisions. Aaron, I'll turn it over to you in a second. The one thing I'll plug on the planning side, as many of you hear me talk about, we've been reviewing a lot of plans across the board for everyone. If you haven't, let us know. I think it's a good time often to revisit your plans and look at how well markets have done over the last few years and really probably put you ahead of where you need to be long-term anyway. So these blips really are not as impactful long-term. And on the second point there is, if you do have cash outside of an emergency savings fund, outside of where you're starting to allocate funds to your 401k and those types of things that we're constantly talking about, now is a good time likely to add to some of the portfolios that you have, whether it's with us or other places. So that's all I'll say. Aaron, if you want to mention just some of the things that we're talking about with other colleagues or family, friends, those kinds of things, I'll let you.
Sure. Thank you, everybody. Yeah, just know that we're here as a sounding board to everyone who is a client and to those who are not. So if somebody, look, there's stressful times when you see on paper markets dropping, values of accounts dropping. So happy just to be a sounding board for anybody who needs it. We are updating plans. We'll see over the next handful of days, week, as Matt was alluding to, the rebalancing that we're going to do. You will see some trade notifications. So if you want any more clarity on what they are and why, happy to discuss. But we're here and available, and just want to thank everybody for taking the time to call in.
Very good.
So thank you again. Anybody that needs to chat, we're here. Feel free to give us a ring. And thanks again, everybody, for your time.
Thanks again.
Have a great day.
Bye-bye.